Last week, Charlie, S&P released its semi-annual SPIVA report on the state of active management. And they've been following active management for 25 years. It's basically how active management performs against their benchmark. So far in 2022, I thought this was very interesting. It's been a good year for active management. 51% of large cap active fund managers are underperforming their benchmark. I know, 51% underperforming. It sounds terrible, but it's the best year for active management since 2009, believe it or not. Now, the long-term records, you see them here, are terrible still. After 5 years, 84% underperform. After 10 years, 90% of active fund, big cap fund managers underperform after 10 years. You pointed this out 50 years ago. This dismal record. Why is it so difficult for active managers to outperform?
Well, there are a whole bunch of different reasons, but they all come together, meaning that the markets have gotten better and better and better and better at pricing. And that's the function of any market, is to find the right price and make it available to people who want to buy or sell. So if you start off and take a look at some of the changes, when I came out of Harvard Business School in 1963, there were no courses on investment management. None. Now there's 7. If you look at how many students took courses in investment management, it's now over 100%, because many people take more than one course. And you look at some of the other changes. The trading volume on the New York Exchange was 3 million shares a day. Now it's somewhere between 6 and 8 billion shares a day. That's an enormous change. And the volume in trading is reflective of all the people that have gotten involved in active investing. Back in 1963, for an example, there were as many as 5,000 people were involved in trying to figure out what stock prices should be and what the earnings were going to be. Now there are easily 2 million people who are involved in feeding information into the active managers. Like Bloomberg was still in school, now the Bloomberg terminals, everybody has one. Most people have one at home and one at work. And a lot of people have one at home, one at work, and one in the limousine as they drive to work, because they want to be able to have access to all that extraordinary information. You take all of these different changes that have taken place, they've all contributed to making the markets more efficient, more correctly priced, and you've got a change in the volume of trading that's done by professionals, went from less than 10%. When I say professional, you got to believe it's a very broad and friendly general definition, because that included bank trust departments in 14,000 banks across the country. And the only people who went into the trust department were the people who were not doing very well at the commercial banking business. They got transferred. We've gone from 8, 9, maybe 10% professional trading to 90%, 95% professional trading. So anytime you go to the market as an active manager, you're buying from, selling to, other people know exactly what you know, just as fast as you know it. That makes it awfully hard to get ahead of anybody else.
Yeah, Nick, Charlie makes a very key point. It's not that active managers don't underperform because they're stupid. Exactly the opposite. They're all really good, but you're primarily trading against other active management. And as Charlie pointed out, what is the real information advantage when everyone has essentially the same amount of information? We always derisively refer to retail traders as dumb money, but they didn't have the same information advantages that professional players have, but there's not as many of them anymore.
Right. It's important to remember that efficient market theory doesn't say markets are priced correctly every day. It says there's no reliable way to find the mispricing. And that's still true, and that is why active management is so hard. You might catch one name or 2 names or 3 names and think you're doing pretty well, but then you get reversion to the mean and you don't get that performance going forward. So it isn't just that markets are priced incorrectly or correctly. It's very hard to find the systematic mispricing enough to outperform.
Yeah. So what do you do? I mean, we talk about efficient market hypothesis, and generally what people say now is markets aren't completely efficient, but they're efficient enough. Now, repeat the point you made just earlier there, that efficient markets doesn't say that every moment they trade at the correct price. It says what?
Yeah, it doesn't say that price that we're seeing across the tape right now is correct. It says there's no systematic way to find the mispricings, meaning there's no way to find the anomalies enough to make consistent outperformance. Yeah. So that is the trick. And basically, great investors who I've met who do it well focus in on one core edge. Warren Buffett's beaten the market. How did he do that? He understood the value of brand. George Soros beat the market. How did he do that? He understood how currency markets work and that central bank interventions are dislocations that are temporary. Every great investor has one phenomenal idea. And that includes Jack Bogle with indexing, a phenomenal idea that people didn't believe for a long time, and now it's been proven true.
So how do you advise people all the time. How do you tell them about active versus passive management? At what point do you say, I believe active management has a role to play here, for example, in the bond market, when all of a sudden bonds are plummeting in the last year?
Sure.
Is there moments when you can walk in and say, I think active management would do very well here?
The way we look at it is this. The first thing is there's actually no such thing as passive management. Everything, including buying an index fund, is still a choice.
It's an active choice, yes.
And those choices are informed by emotion. And that is something that we talk about a lot. The second is don't take it for granted. So if you think indexing is great, that's fine. But look at the longer returns of the S&P and Russell versus EFA and EM. EFA and EM are basically up 3% a year for the last 10 years, and the S&P is up 10%. Why is that? And understand why it is. We recommend underweighting EM and EFA as dramatically as you can possibly stand, because those are not money-making areas. And according to the current structure, they never will be. So you can be as active.
They never will be?
No.
EFA, Europe, Africa, Far East.
Europe, Asia, Far East.
Asia, excuse
will
me.
never
Asia, Far East.
outperform the U.S. on a
Essentially,
structural basis.
good part of the developed world is in
Yes.
there. It will never outperform?
No, not over a sustainable period. You will catch one cycle when this cycle turns where EFA and EM will do fine. Those are trades. But as far as the underlying underpinnings of venture capital,
and that is because of the U.S. capitalist system. Why is that outperformance?
It's two things. It is we get the right folks into top schools, or at least enough of them to create ideas, and then we have a huge venture capital community that funds their ideas. That is the engine of innovation, the engine of growth.
So it's the capitalist system and our educational system combined.
Yes. Now, our educational system is not so great for the average person.
Yeah.
But if you're gifted with a huge IQ, there's a good chance you can get into those schools, and then a VC will give you money.
Yeah.
As simple as that.
Yeah. Charlie, one of the reasons I love talking to you and reading your stuff is you're full of folksy wisdom. You often have said to me, there's three important numbers that people should keep in mind. I'm going to put them up here on the screen for hand. First is the number 76%. That is the difference between waiting for Social Security at 62 years old and 66 and a half years, meaning that's the difference of what you'll make if you wait until 66 and a half years. The second number is 10, and that's the number Warren Buffett said you would be a better investor if you only had 10 decisions in your life to make, meaning it would limit your options and be good for you to do that. And the third number is 60, which is the number of years most of us have to be investors. These are great numbers. Riff on these for a moment for us.
I'll start with the last one. 60. If that's the reality, then you ought to think about investing with that reality in mind. And the biggest advantage you can possibly have is the long term. So 60 is a very good measure because most people start investing somewhere in their mid-20s and they stop investing somewhere in their mid-80s. But that time period is a wonderful opportunity to take advantage and really do something with it. 76 is, to me, speaking just as an American citizen, the most important single number for almost every single person. Social Security will pay you every year, as long as you live, inflation protected. In the last year or so, we've seen what inflation protected really means. Will pay out to you more every year by 76% if you can wait until you're 70 and a half to claim. In addition, if you have investments and you're working for a company that has a retirement plan and you stay with that company during that same time period, you will at least double the size of your 401k during that same time period. Put those two together and you go from at risk of having an unhappy, impoverished, elderly period in your life to having plenty and being able to do the things that you really, really want to do. I think those numbers are really important for almost everybody. 10, I happen to love because it's an easy way to remember to be self-disciplined. And any advice that any of us get from Warren Buffett is probably darn good advice and we ought to pay attention to it. And 10, if you only can make 10 decisions, then you know they're not going to be because the market is different, not going to be because the economy is different, not going to be because interest rates have changed all of a sudden. It's going to be because you have changed. And if you think in terms of when you're in your early 20s, you've got one set of variables to think about. When you're mid 40s, you've got other things to think about. When you're in your late 60s, you've got other things to think about. When you're in your late 80s, you've got other things to think about. And those would be reasons to think about changing your portfolio structure in response to what your real needs are.
You know, it's a very good point he brings up, that Social Security is inflation protected. Yep. We're probably going to get the biggest increase ever, perhaps, I don't know forever, but this year in Social Security. So it is inflation protected. And when you think about it, and Charlie and I have talked about this many times, there's really three things that you own in your portfolio. You have your house, you have Social Security, and you have your private savings, your 401k, and some people may also have a pension. So I wonder if you can take, if the house is there and your Social Security is there, and that's a significant part of your assets, whether you could stand to take a little more risk owning your 401k, for example. So a lot of people decide when they turn 70, they're going to dramatically reduce stock exposure, but people are living to 90 today. Yeah. You know, I'm wondering what you recommend to people at that point.
We talk a lot about not outliving your money, which is a real problem. And you're right, plenty more people are living past 85 and 90 and even to their late 90s. My mom is 94 years old and still going strong. And thank goodness she had invested a ton in equities in the 90s and 2000s, because otherwise I'd be paying her rent right now. Yeah. So it is super important. You have to plan to live a long time, and if you don't, you don't, but you got to plan for it.
So Charlie, riff on this. Can your 401k, pick up on what Nick was saying, should you take a little more risk in your 401k if you're, say you're my age, I'm 67, so suppose I'm going to live to 90. Can I take a little more risk knowing that I have a house and I have Social Security at the same time? I'm trying to figure out, what are we advising people to do? Because when they turn 70, everybody starts buying bonds, which seems kind of crazy to me if you're going to live another 20 years.
Thank you for saying it just the right way. Kind of crazy is exactly right. Look at the major components of your total portfolio. You've got your securities portfolio, 401k. If you're done pretty well, not superb, but pretty well, you've got something like $250,000 right there. Another value, really important, is your family home, where the chances are you've got another $250,000. And then the third part is your Social Security. Most people have no idea how big the Social Security is. A typical person would have Social Security value coming their way, streamed year by year by year, of another 500,000. So let's go back to the first 250 that you've got in your portfolio at the 401k level. You got 60% in stocks. Okay, well then add your house, which is a stable value, but it's real economic value. Then what percentage is it? It's no longer 60%, it drops to 30%. Oh, wait a minute. Drop in the part you're going to get from Social Security, which is largely like a bond, although it's a fancy kind of bond, but it's a stable value one more time. Then you wind up with, you've got 16, 15% in equities total, in your total portfolio. So I would urge you to think about total portfolio and what percentage of that you feel comfortable putting into the stock market, where the returns are higher.
This makes a lot of sense to me. I mean, people don't think about, for example, your house as part of your portfolio, or Social Security. And in case you're wondering, how do you get, he mentioned $500,000. He's talking about over the lifetime. So an average person might collect, do the math here, $20,000 a year in Social Security times 20 years or 25 years, you get $500,000. That's how Charlie's getting those numbers. So if you think of your portfolio as your house, Social Security, and your 401k, his point is, you may actually own 16% of stocks in your 401k at 60-40, not, 60% if you look at a total portfolio.
There used to be an old rule of thumb that's sort of the rule of 100. So take your edge, subtract that from 100, and that's your allocation. Yeah. It might have to be a little even more aggressive. Yeah. It might have to be 110 or 120. Yeah.
Charlie, you've got the Vanguard book out. I wonder, what's your take on Vanguard today? I mean, obviously it's a huge success. They went into ETFs against Jack Bogle's wishes. Brennan did. But, I hear these complaints from the old guard, the Bogleheads. They say Vanguard has strayed from Jack's principles. It's become a behemoth that offers everything. It shouldn't do that. What's your take on where Vanguard is today?
Oh, I think Vanguard's in an extraordinarily favorable position. Just to be candid, all of my investments are in Vanguard. wife's investments are in Vanguard, and we're independent people in terms of our financial thinking. Our children are all in Vanguard, and our grandchildren are all in Vanguard. So at least I put my money where my mouth is. I've had the privilege of working with Vanguard one way or another for 60 years. And it is the same organization all the way through. All the changes that have taken place in Vanguard, it's the same organization in terms of values, what it's trying to do. And it's really trying to provide highest value at the lowest possible cost for the largest number of investors. And that's why they have been far and away the most successful mutual fund management company in the country. And really substantially so, starting from when Jack first left the Wellington organization. He was starting with 27 other people, no assets under management, and no way of adding new business except it was paid up to him, delivered to him through the organization he was serving. Over the years, developed all these other capabilities so that same mission, same purpose, serve the people who would like to have long-term investing in high quality at a low cost. That's a wonderful metric. And it causes people to come together wanting to work at Vanguard, causes people to stay employed with Vanguard. It causes people to invest with Vanguard to feel really great about it and stick with it for the long run. You can argue, and I think it's a fair argument, that there are parts of the service activities of Vanguard these days, everybody working remote, that are not as up to speed as some of the past capabilities. And candidly, Fidelity has got a super service level so that they've done even better than Vanguard. But in terms of organization, there's something really important about Vanguard for all of us to keep in mind. When Vanguard thought seriously about making an acquisition, they were able to raise $5 billion overnight. Now, how in the world can you do that? You can do that because the fund owned Vanguard. And all the funds had to do is put a tiny amount of each fund into that pool and then borrow the rest. And they've got $5 billion. So people look at Vanguard and say it's a break-even operation, correct? Very cost-conscious, correct? They can't possibly make a capital investment, incorrect, because they do have the capability of not reducing fees or letting fees rise up a little bit. And on an $8 trillion base, right, you come up very quickly with 80 million bucks every year for the rest of your life. And that gives them a capital throwaway that almost nobody has in mind when they think about Vanguard.
Are you suggesting?
Major commitment, delivering advice, and the kind of advice that they're delivering is increasingly sophisticated, and that's the new wave in the investment management industry, is good advice for individuals who'd like some coaching on what they should do.
Yeah, self-directed investing advice. Are you suggesting, I was intrigued by what you said about they could make acquisition if they want, raise $5 billion. Are you suggesting they should? If so, what should they buy?
But they could have when they were thinking about making an acquisition. And that was the ETF business that was originally Wells Fargo, and then Wells Fargo and Nico, and then it was acquired by BlackRock, which made a brilliant move to buy in at the right time. But they bought the whole organization, which was more than Vanguard would have been interested in doing. Tip of the hat to BlackRock, but then a very nice insight into, when Vanguard really wants to get something done, they can get it done.